Hey everybody, Josh Sigurdson of World Alternative Media here, and we are joined by David Garofalo, CEO of Gold Royalty, and today we are going to go into the existential crisis we face as fear of an imminent dollar crash and the solutions for said problem. We're going to talk about all of that today. First of all, thank you very much for joining us.
Thanks for having me on, Josh. My pleasure.
Excellent. Now, the Biden administration, alongside pretty much every president in the last century, especially the last 50 years, has been a big fan of the printing press. Money is being printed like never before. The debasement of currency is astronomical and affects every individual on earth when they go to the store. So I wanted to ask, how catastrophic will the end result of said printing be, in your opinion?
Well, it really is unprecedented. And I would harken back to the credit crisis we experienced about a dozen years ago, where we actually saw not only the US printing money, but we saw a coordinated effort across all the central banks, the industrialized world, to actually print money and debase their currencies, competitively devalue their currencies and preserve export markets. And we're seeing essentially perpetuation of that in the current crisis through the pandemic. And even before that, there was a drive to bring interest rates down lower, both on a nominal and a real basis. We never really experienced interest rates, negative nominal rates in many jurisdictions, and certainly negative real rates when you consider the effects of inflation. And that's likely to be amplified going forward because we are going to experience significant inflation. So even if nominal rates start to creep up, as the Federal Reserve is intimated recently over the next couple of years, we're going to see inflation eat away at that. We're going to maintain real negative rates and perhaps even more negative than what we're currently experiencing currently.
And we're hearing a lot of conflicting stuff from the Federal Reserve. I mean, a couple years ago, many of us were called conspiracy theorists for saying, hey, there's probably going to be negative interest rates in the near future. People would say, well, that's crazy. That'll never happen. I mean, even Janet Yellen said, I believe, at the end of 2019, and Powell echoed this sentiment as well, that they don't see interest rates being raised or, lowered for many, many years. Well, obviously, soon after that, interest rates went down. And on top of that, we're getting faulty inflation numbers. We're told that the inflation rate is one thing, and then we're looking at the price of living on the other hand, and it's clear that the inflation rate is much different. Why do we keep getting this conflicting dialogue from the Federal Reserve? It seems like they're on a different wavelength than the rest of us.
No, look, I think they're being disingenuous. The last thing they want to do is undermine confidence in their currencies, but also into the equity markets. And it seems to me that the central banks pay much more attention to the direction of the equity markets than they actually do to fundamental economics, which is really what's supposed to drive their decision making. So it's really changed since really at the Alan Greenspan days, the focus has really been on maintaining that upward trajectory in the equity markets, making people feel wealthy on paper. And what we've seen is really a perversion of the multiples that we generally experience in the underlying economy in the general equity markets. We've never seen multiples stretched on price to earnings, price to cash flow to the degree we've seen now. There's likely to be a severe correction, I think, in the medium term, and that really will drive people, we think, into the reserve currency like gold.
And people always seem to go in the wrong direction. They don't look at the real solutions. They ask for more of the same thing that's causing the problem in the first place. I see so often, well, maybe we need to raise minimum wage, or maybe we need to do more spending. And it's like, well, wait a second. If you could have a higher number on your currency, it doesn't change the fact that the currency is being debased and losing value. And that's why I do want to go into gold with you. Gold has had a shaky 10 years after its historic rise a decade ago. It has been dramatically manipulated by banks, found guilty in court of spoofing. It would take an hour just to name half the banks involved in the spoofing. With the inflation rate artificially lower than it actually is, do you think gold is also artificially far lower than it should be in value? Where do you think gold should be at this point, minus the manipulation we've seen?
Well, there's no reason that it shouldn't be back to its real all-time high, which is in fact is close to $3,000 an ounce, in my view. And where I come that number is, if you go back to 1981, when we last experienced hyperinflation, gold achieved a high at that time in 1981 of $850 an ounce. You inflation adjust that, that's about $3,000 an ounce today. There's no reason we shouldn't be at that level. And in fact, I would say that the amount of quantitative easing that we're experiencing now far exceeds what we saw even in the hyperinflationary era of the 1970s and 80s, when oil prices were galloping to untold or unprecedented levels at that time. So we are in that type of environment. I think we should see gold at least go to 3,000. Merrill Lynch recently came out with a forecast of $3,000 an ounce, and that's not coincidental. I think they looked at the real all-time high and saw the same sort of fundamentals that we're seeing.
Absolutely. So right now, let's be honest, the big thing is cryptocurrency. I'm a big fan, but of course, I've always been a huge fan of gold due to it being a hedge against inflation and more of a wealth insurance than strictly a speculative investment. Do you see gold keeping up in the digital age like it has in past crises?
Yeah, no, listen, there's no reason that gold wouldn't be adaptable to digital currencies. And I think there'll be a desire for physically backed digital currencies. And in fact, I launched one when I was at Goldcorp, and it's had gotten some traction. And I think what the Bitcoin and other cryptocurrencies have demonstrated is a desire for a new class of investors, maybe younger investors, for a reserve currency. They intrinsically, implicitly understand that their paper currency is being debased, and they're looking for life preservers. And so that's really what's driven capital into Bitcoin. And I've been asked, is Bitcoin kind of stolen our thunder on the gold side? I say, yeah, to a degree they have. They've done an exceptional job of attracting that new class of investors that is looking for protection against the inflationary environment that we find ourselves in. And so the only thing I would say to counter that argument is, what gold has physical properties, has been recognized as a reserve currency for 4,000 years. I would say Bitcoin doesn't have that kind of physical backing. In fact, what really concerns me about Bitcoin and cryptocurrencies generally is there really are no barriers to entry. While Bitcoin has a finite quantity attributed to it, there's no reason that we wouldn't see other cryptocurrencies introduced in the market to steal away some of that market share. And that would be my concern. There really is no competitor for gold that has that kind of physical property. There's a very finite quantity of gold on the Earth's surface, 200,000 metric tons since the beginning of time. That's tiny. And in fact, you could fit that into 4 Olympic-sized swimming pools. Volumetrically, it's a very, very small quantity. And we only, as an industry, produce around 4,000 metric tons of gold per year. So we're not adding appreciably to the supply. And there's no elasticity of supply to price. In fact, the mine supply is going down even as the price has been going up because of the difficulty of getting new mine construction executed on. So I would say that gold is still the true reserve currency, and will be recognized increasingly so as we start to experience that hyperinflation that we see coming.
Yeah, we definitely see a lot of governments around the world reacting in that way as well. And, with only 1 or 2% of the world in cryptocurrency, I'm very bullish in the future for adoption. However, gold has the security of thousands of years, which obviously when you're dealing with a risk analysis, obviously gold is more secure from the perspective of especially wealth insurance. It's not about just investing and trying to play the gold market and make as much money as you can. It's about being able to put it under your bed and not worry about volatility to such a great degree, and also know that no matter what, it's still going to be more valuable than the US dollar at the end of the day. You've got an incredible background. You could have joined any gold company, but you joined Gold Royalty. First of all, can you explain Gold Royalty to our audience, and with that, why you got on board?
Sure. I mean, maybe I should talk about royalty vehicles generally and how they work, and how I think they're a tremendous value proposition when you're looking to play in the gold market. Royalty companies effectively lend money out to gold companies and developers to help build mines. And then we take a royalty back on the property in exchange for putting that capital in. And so effectively we have top line exposure. We get, typically 1 to 2% of the revenue coming from a mine once it's productive. And so we have full leverage to the gold price. So as the gold price goes up, our revenue goes up because we get a fixed percentage of that revenue. But what we also have is leverage to the exploration success of the companies, the operators that operate those mines. So if they grow their reserves, we get that upside benefit. And so when you compare us to, say, the GLD, the gold-backed equity that's available on the NYSE, What we do provide is leverage like the GLD does, but the GLD doesn't provide that kind of expiration leverage. You know, you get a physical amount of gold back in your GLD certificate, but you don't get any upside as a result of expiration. So we provide leverage to the gold price and leverage to the expiration. When we compare ourselves to the operating companies, sure, the operating companies provide leverage to the gold price and leverage to expiration, but they also have operating capital cost risk. So if they see significant inflation, that erodes their margins and erodes the profitability. We don't have that exposure to royalty companies. Again, our exposure is strictly on the revenue line, not in the operating costs. So every dollar movement in the gold price up goes right to our bottom line. Any increase in the reserves, again, goes right to our bottom line. We get the full exposure without any of the downside risks associated with operating companies. With Gold Royalty, the way we created that, we just IPO'd it last month, and we're trading on the NYSE American under the symbol GROY. We raised $90 million US. And we did that off the back of a portfolio of royalties written on our parent company's assets. They have about a dozen development stage assets. This is gold mining. They're publicly traded on the NYSE as well. They decided to write royalties on those and create a new royalty vehicle, spun it out to raise its own money. And off of that base, which collectively is 26 million ounces of gold reserves and resources across those dozen properties, we have now a mineral endowment from which we can, and base from which we can grow our business by acquiring new royalties. And we certainly have a very full treasury to do that. And we have a very strong management team backing it. I have over 30 years of experience on the operating side. John Griffith, our Chief Development Officer, ran Merrill Lynch's mining group from the banking side for a great number of years. So he brings a lot of transactional experience. And on our board, we have Ian Telfer, who founded Goldcorp and founded Wheaton Precious Metals by pursuing effectively the same model that we pursued with Gold Royalty. He wrote royalties on Goldcorp's assets 15 years ago and created a separate royalty vehicle called Wheaton Precious Metals, which is now one of the biggest by market cap royalty and streaming companies in the world. So it's a model that's been tried and tested, and we're pursuing that with Gold Royalty.
So what sets Gold Royalty apart from the competition, would you say?
Well, I would say in that sub $1 billion market cap category, and there's been a proliferation of them that have come to the market over the last couple of years, is that significant foundational mineral endowment that we have. We have, again, 26 million ounces of gold reserve and resource in those projects that we have royalties on. That by far is the largest among that sub $1 billion category. The other thing that we have is a team that has a lot of deep experience in actually running mining companies. And none of those other royalty companies in that category have that. Many of them are financial engineers, they're former bankers, former sell-side analysts. They never built anything other than a spreadsheet. And I think that's what distinguishes us. We've built mines, we've operated mines. So we have a very clear-eyed view of the underlying risks of the assets we're taking royalties back from. But also we have collectively over 250 years of mine operating and mine building experience within that board management, which gives us a very deep Rolodex for us to access new opportunities.
Right. So there seems to be a lot of upside potential going forward. So what is your plan for this year going into 2022? What are you most excited about?
Well, I'm excited about the opportunities on the royalty side. Given the lack of mine construction that's gone on over the last 6 or 7 years, we've seen actually a 40% decline in reserves across the industry. And so that means that mining companies, as an existential imperative, are going to have to refocus back on mine development. And royalty companies are an important part of the ecosystem when you go through that kind of construction cycle, because they provide a meaningful source of low-cost capital to fund mine construction. So this is the right time to be in the royalty space, because the operators are going to have to reinvest back into the ground because they haven't done that in the last 6 or 7 years. And we're going to provide a meaningful source of capital and cost-effective capital for them to undertake their mine development plans.
Excellent. So can you give our audience an elevator pitch on why they should consider investing and getting involved? And I do want to point out before you go into that, for the viewers watching, all the information you can find is linked below, and none of this is investment advice. Always do your own due diligence, all the legal jargon. But with that said, what would your elevator pitch be to our viewers on why they should consider getting involved investing?
Well, as I said, I think the significant mineral endowment, we have a lot of organic growth inherent within the portfolio. We inherited from gold mining, our parent company. And so you'll see a lot of leverage to exploration success, de-risking of those underlying assets as they're developed. Collectively, that's 12 projects, 26 million ounces in an industry that's capital starved, that's project starved, and looking for growth. And we have it inherent in our parent company, gold mining. And as that company pivots towards developing those assets and de-risking them, we're going to benefit as the royalty holders in each of those projects. We also have a treasury of $90 million available to reinvest into new opportunities with no debt on the balance sheet, a very clean capital structure. So we have very, very accretive opportunities within our portfolio and the ability to acquire accretive opportunities in the royalty space to diversify that portfolio. So I think we're going to see a lot of growth. I'd say exponential growth in the value of our business, both organically and through our acquisition efforts over the course of the next year.
So I'm always happy to have people on that are running excellent companies. In my opinion, I see a lot of upside going forward, and there's a lot of opportunity there. And also, I do believe that the gold market will see a massive boom in the near future, just based on the crises that we're facing around the world. Gold always reacts, and we can remember the last major historic leg up was due to the financial crisis, 2007, 2008, up until about 2012. And it was an incredible time to be in the gold market. And I think that with the crisis we're seeing today, it's an existential one, and it's greater than what we saw back then, in my opinion. And going forward, people are going to be happy to be able to actually ensure their wealth. And there is speculation to be had there as well. And with that said, there's companies that are doing excellent work like yours that people can be a little bit more speculative with, in my opinion, than just gold by itself. Because again, gold is, as it stands, a great wealth insurance and not always meant to just be strictly an investment. So as always, do your own due diligence, my friends, and check those links below. But before we go, if our audience wants to get involved, where can they go to find more information? What are the tickers?
So GoRoyalty.com is our website, and our ticker symbol is GROY, GROY on the NYSE American.
Excellent. Well, I really appreciate you joining us today. Always an interesting conversation with people who actually know what they're talking about when it comes to the Federal Reserve System, gold, and the future, and facing the realities. Look, things are going very digital right now, but there's still so much security in gold that we don't have in these other assets. And it looks like your company is doing great stuff, and I hope our viewers take interest. So thank you very much for joining us today.
Well, thanks for having me on. It was a real pleasure.